Welcome to another REG walkthrough video. I'm Logan, and in today's video, we're going to be going over calculating the qualifying business income or QBI deduction. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If this is the first thing you're seeing from us, or if you don't know much about our strategies, be sure to go to SuperfastCPA.com and check out our free 1-hour training webinar, where we go over the 6 key ingredients to passing the CPA exam. The link will be in the description, and it will look like this. It will save you so much time and struggling with your process. Definitely go check it out. Also, if you like the idea of going through questions to learn the material, be sure to check out our Superfast CPA app, where we not only have audio notes and review notes that you can access, but also 5-question mini quizzes that you can easily access on your phone all throughout your day to continually be learning. With all that said, let's dive straight into the questions. Okay, as we get into these questions, one thing I want to say about QBI can be simple or it can be extremely complex. As far as the CPA exam goes, we're going to just be covering the basics because that's all you need to know for the exam. I personally, when I worked in taxes, really struggled to understand QBI because a lot of the situations I was handling were the complex QBI situations. But again, we're going to be doing the more simple and basic stuff for the exam in this video. So let's go ahead and start with question 1. John and Jane Doe are married and file jointly. They own a small design firm that is considered a qualified trade or business. This year, the firm made a net profit of $120,000. What is the qualified business income, or QBI, deduction for John and Jane Doe? So if you don't know anything about QBI, then you're not going to know how to do this calculation. So let's go ahead and go straight into the answer to learn what the basics are. Okay, so 24,000. The basic calculation for the QBI deduction is 20% of the net profit from the qualified business. In this scenario, John and Jane Doe's QBI deduction would be 20% of their firm's net profit of $120,000, which is $24,000. This calculation is straightforward and does not yet involve any of the limitations that can apply to the QBI deduction. Again, there's more complexities. We're going to dive a little bit into some of the limitations in a few questions. A qualified trade or business, for the purposes of the qualified business income deduction, is any trade or business except for the trade or business of performing services as an employee. Generally, the IRS considers a QTB to be any business under Section 162 of the Internal Revenue Code, which includes most profit-seeking activities that are continuous and regular. Now, with that said, that doesn't mean that if you work in a service industry that you're totally blocked from the QBI deduction. Let's read a little bit more. However, there are specific service businesses known as specified service trades or businesses, or SSTBs, which may not qualify for the QBI deduction if the taxpayer's income exceeds a certain threshold. So they can qualify for it underneath a certain threshold. If the taxpayer's income from an SSTB is below the threshold, the QBI deduction is applied normally. So applied the same way as it would be to a QTB. SSTBs include fields like health, law, accounting, consulting, financial services, performing arts, and others where the principal asset is the reputation or skill of one or more of its employees or owners. So it's less about the product and more about what the people can provide. So we learned the basics there. Essentially, the QBI deduction is typically 20% of the qualifying business income, and that applies to qualified trader businesses and also to specified service trades or businesses, although there are limitations that we're going to be learning in the next few questions. So let's go ahead and go to the next question. Here's question 2. Samantha is a successful attorney running her own law practice. During the tax year, her practice earned a net income of $180,000. Samantha files as a single taxpayer with a total taxable income of $210,000. The threshold for a single taxpayer to fully qualify for the QBI deduction without any phase-out is $250,000 this year. What is Samantha's qualified business income deduction? Okay, so it sounds to me like this is an SSTB, a service business, because she's operating a law practice. So let's dive into the answer to see how this differs, if it differs at all, from the first question. Okay, so $36,000. And that looks like that's 20% of the qualifying business income. Okay, since Samantha's total taxable income is $210,000, which is below the single filer threshold of $250,000 for the QBI deduction, her income from the SSTB is fully eligible for the QBI deduction. The QBI deduction is calculated as 20% of the qualified business income. Therefore, Samantha's QBI deduction would be 20% of her net income from the practice, which is 20% of $180,000 coming to $36,000. So this is just another example. Again, very simple as long as you're underneath that threshold. But now we're starting to introduce it. There is a phase out limit. This is not the actual phase out limit for 2023, 2024. This is just a generic phase out limit because again, in these videos, we're not trying to teach you the specific numbers for reg because in all honesty, the AI CPA in most situations is not trying to test you on specific phase out limit numbers and things like that. They want to make sure you understand how it works because the numbers are going to change from year to year. So we just need to know that there is a phase out limit each year. And since this is an SSTB, we would need to consider that. And you do consider it for qualified trades or businesses as well, but it's a little bit different. But since Samantha is under that threshold, it's treated the same way as it would be if this was a qualified trader business instead of an SSTB. Okay, so just wanted to show how similar they are there. Now let's start getting into a few of the limitations. And let's go to the next question. Okay, here's question 3. Michael is a single filer who owns a consulting business which qualifies as a qualified trader business. His net income from the business for the tax year is $250,000. Additionally, he has a taxable income of $260,000, which includes the net income from his business and no net capital gain. The consulting business paid $70,000 in W-2 wages. What is Michael's QBI deduction? Okay, so we've learned the basic 20% QBI deduction. So see if you can get the correct answer. But as I said, we are going to start introducing some of the limitations in this question and the following questions. So go ahead and pause the video if you need to, see if you can get the correct calculation. And when you're ready, come back and we will look at the answer to learn a little bit more about some of the limitations that come up with QBI. And here is the answer. To determine the QBI deduction, we calculate 20% of Michael's QBI, which is 20% of 250,000 equaling $50,000. So again, that's normal. However, and we haven't considered this up to this point because we haven't really needed to, there is a general limitation that states that the deduction is the lesser of all QBI deductions or 20% of the taxpayer's taxable income less any capital gain. Since Michael's taxable income is $260,000 and he has no net capital gain to subtract, we calculate 20% of $260,000, which equals $52,000. Therefore, the general limitation on his QBI deduction is not triggered, and Michael can take the full deduction of $50,000. So this is the first limitation, and this is an overall limitation, a general limitation that you apply to all QBI situations. We haven't really needed to consider it because the total taxable income of each person so far has been pretty close to the QBI or the qualified business income. But this is important because if a person has QBI but then has a lot of other taxable income on top of that QBI, this limitation is important because it can limit how much of the QBI the person can take. And by the way, this right here, the 20% of the taxpayer's taxable income less any capital gain, is before the QBI deduction. So you don't take into account the QBI deduction right here. And also, when it says lesser of QBI deductions, that's because you can have qualified business income from multiple different sources. So you calculate 20% of all that qualified business income and add that all up together, and then it's the lesser of that or the 20% of the taxpayer's taxable income less any capital gains. So again, this is a general thing that you want to consider for all QBI situations. So with learning that limitation, let's go to the next question. Okay, here's question 4. Alex is a single filer and the sole owner of a marketing agency, a qualified trade or business, with a net income of $500,000 for the tax year. His total taxable income for the year is $550,000, which includes the net income from his business. The agency paid $100,000 in total W-2 wages to its employees and holds qualified property with an unadjusted basis immediately after acquisition of $400,000. The threshold for a single filer's taxable income to be eligible for the full QBI deduction without any limitations is $170,000. And again, just a reminder, that's not the actual limitation in 2023 or 2024. It's just for this question. Since Alex's taxable income is well above this threshold, he must consider the limitations on his QBI deduction. What is the maximum QBI deduction Alex can claim under the limitations? Okay, so we learned about the general 20% of taxable income less any capital gains or all the QBI deductions together. We learned that general rule, but there are a few more limitations that we want to learn in this video that you need to at least know about. for the CPA exam. And with that said, let's go straight into the answer for this one because this is where it starts getting a little bit more complicated. So the answer would be $50,000. All right, let's dive into this. When the taxpayer's income exceeds the threshold, the QBI deduction will be limited to the greater of 50% of the W-2 wages paid by the business or the sum of 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. Okay, so just before we dive into that calculation, this is for qualified trades or businesses. And we're going to look at service trades or businesses in the next question. But for qualified trades or businesses, there is a phase out limit for how much taxable income you can have and still have the QBI deduction. And we're not going to dive into the complexities of once you reach the bottom of that limit, how it calculates in the phase out range. What we're going to talk about is when you're below that phase out range, the QBI deduction is normal. And when you're above the full phase out range, so we're not talking about all this stuff in the middle of the phase out range. Once you're above the phase out range for QTBs, this is the calculation that you do. So again, it's either 50% of W-2 wages or 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. So that would be 50% of 100,000, that's $50,000, or the 25% of 100,000 and 2.5% of 400,000 equaling $35,000. And it's the greater of these two. So between the greater of these two, that's what you take as the QBI limitation or the QBI deduction. No longer can you take the 20% of QBI. It is limited to the greater of these two. Now, that can be a little bit complicated, and that's about as complicated as we're going to get in this video. We're not going to dive in to the complexities of figuring out exactly how much of the QBI deduction is limited when you're in the phase out range. We're only talking about when you're below the phase out range and when you're above the phase out range for qualified trades or businesses and specified service or trade businesses. So again, this is the most complicated we're going to get for the CPA exam. I wanted to make sure you knew about this. Hopefully you won't have to deal with this complicated situation, but I felt it was important that you should know about it. Let's go to the last question and see how these kinds of situations affect SSTBs instead of QTBs. Okay, here's question 5. Emma and Liam are married and file jointly. Emma is a partner in a health clinic, which is considered a specified service, trade, or business. The clinic earned a net income of $450,000 for the tax year, which represents Emma's share of the QBI. The couple's total taxable income, including Emma's QBI, is $700,000. The threshold for the full QBI deduction for married couples filing jointly is $340,000, with the phase-out range up to $440,000. So again, the range in this situation is $340,000 to $440,000. There's calculations that can happen in between there, but we're only focusing on the fact that they are actually way over that max phase-out range. So given their income level, how much is the QBI deduction for Emma's share of the clinic's income? So again, this is different for SSTBs compared to QTBs. So let's go into the answer to see how this works. Okay, so the answer is $0. So for SSTBs specifically, this is how it works. Since Emma and Liam's combined taxable income of $700,000 exceeds the phase-out range for the QBI deduction for an SSTB, Emma is not eligible for the QBI deduction for her share of the clinic's income. The threshold and phase-out range for married couples filing jointly mean that the QBI deduction completely phases out above $440,000 of taxable income. Therefore, the QBI deduction for Emma's SSTB income would be $0. Okay, so this is different than with a qualified trade or business. When it comes to qualified trades or businesses, once you pass that phase-out range limit, that's when the full 50% of W-2 wages or 25% and 2.5%, that whole rule that we just went over. For QTBs, that's when that applies. So you can still take some of the QBI deduction with QTBs, even if you're over the phase-out range. But with SSTBs, once you're in that phase-out range, it starts diminishing the deduction. And once you're above the full range, your taxable income is just too high. You don't get to take the QBI deduction at all for SSTBs. So that's the difference there. And that's what I wanted to go over in this video was the basic calculation, and this is what you'll encounter in most situations on the CPA exam, is just 20% of QBI, or sometimes it is the lesser of, all the QBI deductions, or the taxpayer's 20% income less any capital gains. That's about as complicated as it will probably normally get, but just in case you ever see this, if you're ever above the range for a QTB, you may need to apply the 50% of W-2 wages or 25% and 2.5% of the unadjusted basis. Or If it's an SSTB, if you're above that range, you don't get to deduct any of the QBI. So with that said, let's go ahead and finish the video by doing one more part of the SuperFast CPA strategy, which is something called pillar topics. Pillar topics is essentially as you're going through the questions and after you go through the questions to learn the material, you will notice the 3 or 4 things that you obviously were supposed to learn from those questions. These are things that you constantly saw throughout the questions and that your review course was obviously trying to teach you. So you take a second and write those down so that you know them for the future. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics and we're going to go over them to finish the video. The QBI deduction is typically 20% of qualified business income from a QTB or an SSTB. So again, typically is the 20% of the QBI. If the taxpayer has taxable income other than the QBI, then you do need to take into consideration the general QBI deduction limit, which is taking the lesser of all QBI deductions, or 20% of the taxpayer's taxable income less any net capital gains. And again, that's before taking the QBI deduction. The QBI deduction is applied the same way for QTBs or for SSTBs if the taxpayer's taxable income without the QBI deduction is below a certain threshold. So again, if you're underneath the threshold, it's the same whether you're a QTB or an SSTB. Once their income passes the threshold, that's when the other limitations start applying. QTBs start to look at W-2 wages paid and unadjusted basis of assets put into service to start reducing the QBI deduction. SSTBs start reducing the QBI deduction in the phase-out range, and once above the phase-out range, the QBI deduction is not allowed to be taken. So again, this is the most complicated it gets. We didn't go over how it works in the phase-out range because that's where it gets the most complex, because you're still taking into account the W-2 wages and the unadjusted basis in the range, but it affects it differently depending on how far into the range you are. And same thing with SSTBs, the calculation is phased out in the range, but we didn't go over how to calculate that. So the most important thing you need to know is that when you're underneath the phase-out range, this is what you focus on. And when you are over the phase-out range, you apply this limitation for QTBs, and for an SSTB, you don't get to take the QBI deduction at all. With that said, that is the end of the video. Just as a reminder, be sure to go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the 6 key ingredients passing the CPA exam. It will be well worth your time. Also, if you liked going through the questions as your main learning material, make sure you check out our Superfast CPA app, where we have 5-question mini quizzes that you can continually access throughout your day to always be learning and improving. If you like this video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.